Welcome to the Deep Dive. Today, we're tackling a really interesting question. What if some of the best wisdom for handling your money, and maybe even your whole life, came from somewhere totally unexpected?
Yeah, not, some ancient sage or a guru on a mountain.
Exactly. But a modern titan of finance, a guy who actually built an empire by, well, giving more back to the everyday investor.
We're talking about Jack Bogle, founder of Vanguard.
That's the one. His impact, I mean, it's just enormous. Hard to even quantify, really.
Mm.
People say he saved investors, people like you listening, literally trillions of dollars. Trillions.
Maybe even more important than the money saved, he democratized investing. He really did. Made capital markets, which can feel so intimidating, right? Made them accessible, affordable for millions of regular people.
And how did he pull that off? Well, it was mainly through two things. Pioneering the index mutual fund and just relentlessly hammering away at costs, driving them down across the whole industry. It was like this quiet revolution.
A quiet revolution that pretty much affects every single investor today, whether they know it or not.
But here's the fascinating part, and what we really want to dig into. Was his contribution just, a smart business idea? Or something more?
That's the key question, because you could argue it wasn't just financial innovation. It was, in a lot of ways, a practical modern philosophy put into action.
A philosophy. How so?
Well, think about his core ideas. They were incredibly straightforward, often completely against the grain at the time, but always grounded in what he saw as just basic common sense, prudence, ethics, a really clear view of long-term well-being.
So not just investment rules, but life lessons.
Exactly. They absolutely extend beyond just your stock portfolio. They kind of offer a blueprint for making sound choices, period.
Okay, so that's our mission for this deep dive then. Let's unpack this idea. Was Bogle really an accidental philosopher? Did his financial ideas spring from a bigger worldview?
Yeah, we'll look at his main tenets. Indexing, minimizing costs, the long-term view, simplicity, that crucial idea of fiduciary duty.
And see how they all fit together, how they form this coherent philosophy for, well, both markets and life. I think there might be some real aha moments here for listeners, things that could genuinely simplify how you think about your money, your future, maybe even your choices day to day.
Absolutely. We'll see how it's all rooted in this deep realism, ethical integrity, and this really insightful idea of what's truly enough.
Okay, so where do we start? To understand the philosophy, we probably need to understand the man, his background.
Definitely. We need to go back to his early life. The crucible of his character, you might say.
John C. Jack Bogle.
Yeah.
Born May 8, 1929, Montclair, New Jersey.
And his childhood, well, it was dominated by the Great Depression.
Dominated is the right word. It wasn't just some historical backdrop for him. It was intensely personal. It shaped everything.
How so? What was the direct impact?
His family had been pretty affluent, comfortable, and they lost almost everything. It wasn't abstract financial ruin. They actually had to sell their home. Imagine that as a kid.
Wow. That's tough. Yeah. And his father, under all that pressure, struggled with alcoholism, unemployment. His parents eventually divorced. So Jack saw financial hardship, insecurity, the emotional toll. He saw it all firsthand.
So it wasn't just a tough childhood. It was like an education in prudence.
Exactly. It wasn't theory for him. It was lived reality. It instilled this deep, deep appreciation for thrift, for security, for being careful. These weren't just ideas. They became foundational themes in his whole life and career.
It's interesting. He later said that upbringing, despite the lack of money, was ideal for forging character.
Right. He felt it taught him self-reliance, family pride, civic duty, the real value of stability, and maybe the true cost of recklessness.
So these early struggles really shaped his resolve. And he had talent, particularly in math.
Definitely. That gift for math was his way forward. It got him a scholarship to Blair Academy, then another one to Princeton. He graduated magna cum laude in economics in 1951.
And Princeton is where things get really interesting for the future of investing, right? This is where the seeds were sown.
Absolutely. In his senior thesis, of all places, he needed a topic, something novel.
What was it?
The economic role of the investment company. He decided to look into the mutual fund industry, which back then was pretty small, kind of obscure. Tiny, but contentious, as one article he read put it.
Okay, so he dives into this small, contentious industry. What did he find?
Something pretty radical for the time. He crunched the numbers, did the research, and concluded that mutual funds, on average, well, they couldn't claim to be any better than the market averages.
Why not?
Primarily because of costs. High sales charges loads, they called them, and significant management fees. These costs were just eating away at returns. He saw that the structure itself was making it incredibly hard for ordinary investors to even keep up with the market, let alone beat it.
Wow. So right there, in his college thesis, he's identifying the core problem he'd spent his life trying to fix.
Exactly. It wasn't just an academic paper to him. It was the empirical proof, the theoretical foundation for his whole critique of the industry. It showed this amazing early grasp of why costs mattered so much and the inherent difficulty of active management. He saw the problem clearly, even back then.
And this thesis actually got him noticed, didn't it?
It did. It caught the eye of Walter L. Morgan. He was the founder of Wellington Management Company, a well-respected, more traditional firm. Morgan hired Bogle right after graduation.
And Bogle rose pretty quickly at Wellington.
Very quickly. He was talented, ambitious, eventually became president, chairman. But then came the 1960s, the go-go era.
The go-go years. What was that like, and why was it a problem for a conservative firm like Wellington?
Well, it was this period of intense speculation. Everyone wanted growth stocks, hot new technologies. There was this belief that brilliant, aggressive fund managers could deliver huge returns by trading actively, chasing trends.
Performance was everything. Fast gains.
Exactly, and that put huge pressure on traditional firms like Wellington. Their style was value investing, dividends, long-term, steady growth. Suddenly, that looked slow, boring. Clients started asking why they weren't getting those flashy returns, threatening to leave.
So Bogle felt he had to do something. Adapt.
He did, and this led to what he later called his biggest business mistake. In 1966, he engineered a merger. He brought in a smaller, much more aggressive firm, Thorndike, Duran, Payne & Lewis, or TDP&L.
Trying to inject some of that go-go energy.
Precisely. But he himself called it extremely unwise, even shameful, because the cultures just clashed completely. Wellington's conservative roots versus TDP&L's aggressive short-term focus. It was oil and water.
And then the market turned.
Dramatically. The brutal 1973-1974 bear market hit. The S&P 500 lost nearly half its value. Those aggressive bets made by the TDP&L side went disastrously wrong. The flagship Wellington Fund's performance tanked. The firm's reputation was badly damaged.
And the fallout.
The board blamed Bogle. In January 1974, he was fired as CEO of Wellington Management. A very public, very painful professional failure.
Wow. That's a low point. End of the story for many people, but not for Bogle.
Not at all. This is where his resilience, his strategic mind, maybe even his understanding of corporate structure really came into play. He was out as CEO of the management company, but he cleverly managed to hold on to his position as chairman of the board for the Wellington funds themselves. You see, the funds had a separate board, technically. It was an unusual setup, but it gave him crucial leverage.
Leverage he used to propose something radical.
Totally radical. Drawing directly on his Princeton thesis ideas about shareholder interests and industry structure, he saw the core conflict, the for-profit management company running the funds for its own benefit.
Right. Serving two masters, as he'd later say.
Exactly. So he convinced the fund directors, remember, he was still their chairman, to create a whole new entity, the Vanguard Group. Incorporated late 74, started operations May 1st, 1975.
And the key innovation was?
The ownership structure. It was revolutionary. Vanguard wouldn't be owned by outside stockholders seeking profits. It would be owned by the funds themselves.
Meaning owned by the fund shareholders.
Yeah.
Indirectly.
Precisely. So Vanguard was set up to operate at cost, just covering administrative, legal, compliance stuff, no profit motive for external owners. It was a mutual structure, unprecedented in the fund world.
Strategy follows structure, he said.
That was his mantra. This structure inherently aligned Vanguard's interests with its investors. It eliminated that fundamental conflict of interest. It was genius, born from failure, really. And it perfectly set the stage for his next big move, low costs and index funds.
Okay, so from that challenging start, Vanguard is born with this unique structure. Now let's dive into the core principles Bogle built his philosophy on, the 5 pillars, as we're calling them. And pillar number 1 has to be index investing.
Absolutely central. The cornerstone of the revolution, passive index investing.
It sounds so simple, doesn't it? Just match the market, don't even try to beat it.
Deceptively simple, yeah. The idea is, instead of spending time and money trying to pick winning stocks or finding that rare active fund manager who might consistently outperform, which Bogle argued was mostly futile, you just buy a fund that mirrors a broad market index, like the S&P 500.
And he put this into practice pretty quickly.
He did. In 1976, Vanguard launched the first index investment trust, later renamed the Vanguard 500 Index Fund. It was the first one available to regular individual investors. A truly historic moment, even if it didn't seem like it at the time.
Because it wasn't exactly an instant hit, was it?
No, far from it. It was met with huge skepticism, ridicule even. People called it Bogle's folly.
Bogle's folly. And un-American.
Yeah, un-American for just accepting average returns, like it was somehow lazy or unambitious. The initial fundraising was a struggle. They aimed for much more, but only raised about $11 million. Some called it a flop.
So why was Bogle so convinced despite all that negativity? What was the deeper reasoning?
It wasn't about being mediocre. It was about being realistic, pragmatic. Based on his thesis research and everything he'd seen since, he knew, fundamentally, that consistently beating the market after costs is incredibly hard.
You talk about the zero-sum game versus the loser's game, right?
Exactly. Before costs, active management is zero-sum. For every winner outperforming, there's a loser underperforming. The math has to balance. But then you add costs, fees, commissions, taxes.
And suddenly everyone, as a group, is losing relative to the market itself.
That's the loser's game. The costs drag everyone down. So indexing isn't settling for average. It's intelligently capturing the market's full return, which has historically been pretty good without paying the high price for trying, and likely failing, to beat it.
So the aha moment is realizing that accepting the market return is actually the smarter way to avoid losing to costs.
That's the profound shift in thinking. It's not about lack of ambition, it's about smart strategy based on evidence.
Philosophically, it feels like an act of intellectual humility, too.
Very much so. It's acknowledging, hey, predicting the future is really, really hard. It trusts the collective wisdom of the market, millions of participants pricing assets constantly. It's a move away from the hubris of thinking you can consistently outsmart everyone else.
Towards realism. Grounded in arithmetic.
Right. And his famous line sums it up perfectly. Don't look for the needle in the haystack. Just buy the haystack.
Buy the whole haystack. Love that. It's about broad ownership, participating in the whole economy's growth.
Instead of that costly, often fruitless search for the needle.
Okay, so indexing is pillar one. Pillar two flows directly from it. The absolute obsession with low costs.
Obsession is the right word. If indexing was the strategy, low cost was Bogle's unwavering dogma. He hammered this point home relentlessly. Minimizing costs isn't just helpful, it's paramount for long-term success. It's mathematical certainty.
And he felt the industry was hiding this fact.
Or at least downplaying it significantly. He developed what he called the cost matters hypothesis, or CMH.
The cost matters hypothesis. Okay, what's that?
It's just simple, irrefutable arithmetic. Your net return, what you actually get, is the market's gross return, minus all the costs of investing. Management fees, operating expenses, trading costs, sales loads, advisory fees, taxes, all of it.
And while market returns bounce around unpredictably.
Costs are definite, relentless. They tick away every single day, compounding against you. They are the one thing you, as an investor, can actually control.
And Vanguard's unique structure was the key to controlling them.
It was the perfect vehicle. No outside owners demanding profits meant Vanguard could operate at cost and pass savings directly to investors via super low expense ratios. They even got rid of sales loads entirely in 1977. That was huge. Saved investors billions just on commissions.
And that forced competitors to react, right? The Vanguard effect.
Absolutely. It created this competitive pressure that slowly, grudgingly forced other firms to lower their fees too. So Bogle's actions benefited even people who never invested with Vanguard.
Philosophically, what does this focus on cost represent?
It embodies prudence, maximizing what you keep, frugality, avoiding waste, and fairness, ensuring the investor, not the intermediary, gets the lion's share of the returns. He called high costs the tyranny of compounding costs. He saw it as almost a moral issue.
In investing, you get what you don't pay for.
His classic line, perfectly counterintuitive but mathematically undeniable. While academics argued about the efficient market hypothesis, Bogle said, look, the cost matters hypothesis is the practical reality for every single investor. You can debate market efficiency, but you can't debate the impact of costs on your bottom line.
Okay, so pillar one, index. Pillar two, keep costs low. Pillar three has to be about time, right? His famous mantra.
Stay the course. Absolutely crucial. It's about how long you stay invested.
What does stay the course really mean in practice?
It means patience, discipline, perseverance. It means setting up a sensible long-term asset allocation, your mix of stocks and bonds based on your goals and risk tolerance, and then sticking with it rigorously through thick and thin.
Regardless of market craziness, the ups and downs.
especially regardless of the craziness. It means absolutely rejecting market timing, trying to jump in and out. Bogle called that a fool's errand. He said after 50 years, he didn't know anyone who'd done it successfully, consistently.
He also warned against speculation, didn't he? Confusing it with investing.
Big time. He saw speculation as focusing just on short-term price wiggles, not the underlying value of businesses. And he knew that emotions, fear, and greed were the investor's worst enemies. They lead to panic selling in downturns or chasing bubbles at the top.
That quote about market noise being like a tale told by an idiot, full of sound and fury signifying nothing.
Perfect encapsulation. Tune out the noise. Focus on the long term. That's the discipline required.
Philosophically, this feels very stoic.
Absolutely. It aligns perfectly with Stoic ideas. Patience, discipline, emotional control. Focus on what you can control: your savings, your allocation, your costs, and accept what you can't: market volatility.
Trust the process.
Trust the long-term process of compounding and economic growth. His other great lines capture it. Time is your friend. Impulse is your enemy. And the brilliant, don't do something, just stand there.
The exact opposite of what the industry often tells you.
Precisely. Knowing when not to act is often the most valuable skill.
Indexing, low costs, stay the course. Pillar number 4 is about simplicity. In a world that loves complexity.
Bogle was the champion of simplicity. He swam completely against that tide. He believed complexity often just served the sellers, not the buyers. It masked high costs, hidden risks.
So his ideal was straightforward.
Always. Easy to understand strategies. The index fund itself is the perfect example, but also simple portfolio construction. He often recommended just a few broad-based index funds.
Like the classic 3-fund portfolio.
Exactly. Total U.S. stock market, total international stock market, total U.S. bond market. Simple, diversified, low cost. Covers most of the investable world without the complexity.
And the benefit of keeping it simple.
It's easier to understand, which builds confidence. Easier to stick with long-term, less chance of making emotional mistakes. It promotes transparency. You know what you own and what you're paying. And crucially, it helps you stay the course because you're not constantly second-guessing some complex strategy. It lets you, as he liked to say, sleep well at night. Swan.
Swan investing, I like that.
Philosophically, it's like Occam's razor for finance, right? The simplest solution is often the best. Financial minimalism. Strip away the noise, focus on the core drivers, broad exposure, low costs, time.
Simplicity is the master key to financial success, he said.
And successful investing involves doing a few things right and avoiding serious mistakes. It's about nailing the fundamentals.
Okay, that brings us to the 5th and final pillar. And this one feels like the deepest, maybe the most philosophical. Fiduciary duty.
Absolutely. This was the moral bedrock for Bogle. Fiduciary duty, the ethical and legal obligation to act solely in the client's best interest. For him, this wasn't just a regulation, it was a sacred trust, the absolute foundation of the profession.
And he felt the industry was failing on this count.
Massively. He was a fierce critic of practices riddled with conflicts of interest. He argued the structure of most firms, especially public ones, created this inherent tension. Who do you serve? The fund shareholders. Or the management company's owner seeking profits.
The no man can serve two masters problem again.
Precisely. He believed this conflict led directly to high fees, focusing on marketing and gathering assets instead of careful stewardship, and just a general erosion of ethical standards. He lamented that investment management had gone from being a profession with elements of a business to just a business with elements of a profession.
And Vanguard's mutual structure was his answer to this ethical problem.
It was his radical structural solution. By making shareholders the owners, he eliminated that primary conflict. Vanguard's interests were the investor's interest by design. It wasn't just a business model, it was ethical engineering.
So his advocacy was really a moral crusade.
It truly was. To restore trust, fairness, integrity, he'd insist, we are more than a mere industry. We must hold ourselves to higher standards. He loved quoting Justice Cardozo about fiduciaries being held to something stricter than the morals of the marketplace. Not honesty alone, but the punctilio of an honor the most sensitive.
The punctilio of an honor the most sensitive. Wow, that's a high bar.
And one he believed the profession should strive for. It was about the profound responsibility of handling people's savings, their futures.
Okay, those 5 pillars, indexing, costs, time, simplicity, fiduciary duty, form a powerful investment philosophy. But you suggested earlier it extends beyond investing into life itself.
I think it absolutely does. The common sense wisdom baked into his financial advice offers a really practical framework for navigating life with, well, prudence, integrity, and that long-term focus.
How so? Let's connect those dots.
Okay, take low costs. That relentless drive to minimize fees mirrors a life philosophy of frugality, value consciousness. Avoiding wasteful spending, focusing on what truly provides value that enhances financial health, sure, but also personal satisfaction. Bogle himself lived relatively modestly despite the potential for immense wealth. He practiced what he preached.
Okay, what about stay the course?
That's pure life advice, isn't it? Weathering storms, whether market downturns or life's challenges, requires patience, discipline, resilience. Those are key for any long-term goal, career, relationships, personal growth. Think about Bogle's own life, getting that heart transplant at 66, calling the next 20 years gift years, and just persevering. His attitude of dealing with what is, not what might have been, is pure pragmatic wisdom.
And simplicity.
Same thing. In investing, it reduces errors and stress. In life, seeking clarity, defining what's essential, cutting out the noise that reduces stress too. It lets you focus on what truly matters rather than getting overwhelmed by endless complexity and choice.
And finally, fiduciary duty.
That reflects a broader commitment to integrity, trustworthiness, service. Prioritizing clients' needs in finance is just one application of the universal principle of considering your impact on others, acting ethically, contributing positively, being a person of character.
This connection between finance and life philosophy, he made it really explicit later on, didn't he, in his book, Enough?
Yes, exactly. Enough! True Measures of Money, Business, and Life. Published in 2008, the title says so much.
What inspired that book?
Partly this famous anecdote involving Kurt Vonnegut and Joseph Heller. They were at a billionaire's party, and Heller supposedly said the billionaire had something he, Heller, never would. The knowledge of having enough.
Knowing when you have enough.
Bogle seized on that. The book challenges that relentless pursuit of more, which he saw everywhere. He argued true success isn't just about money. It's measured by character, integrity, contributing to society, and finding contentment with what you have.
So it was a critique of the worship of wealth.
Yes, and the erosion of ethics he saw accompanying it. Enough really ties his whole career together. It explicitly states the values, prudence, ethical realism, sufficiency, character that drove his financial innovations all along. It connects the realism about market returns and costs to a deeper realism about the limits of money and achieving genuine fulfillment.
Beyond the personal philosophy, his work also had this huge societal impact, right? Democratizing finance.
Immense. By making investing low cost and accessible, he empowered millions of ordinary families. People who were previously shut out or ripped off by high fees, he helped them build wealth, save for retirement. That's a massive contribution to social equity, really.
Enabling broader participation in economic growth.
Exactly. And interestingly, even Bogle, later in life, remained a critical thinker about his own creation. He started raising concerns about index funds becoming too dominant, concentrating voting power in large institutions like Vanguard.
Worried about corporate governance.
Yeah. It shows his ongoing engagement, always thinking about the bigger picture, the potential downsides, even of his own success, still advocating, still questioning.
It's clear his ideas were powerful. And while we've analyzed them, sometimes hearing it directly from him is best. His quotes are so memorable.
They really are. Punchy, wise, often witty. They distill his philosophy perfectly. Should we revisit some of the key ones?
Definitely. Let's hear Bogle in his own words on indexing and market realism.
Well, the classic, don't look for the needle in the haystack, just buy the haystack, and the mathematical truth. Owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. Also, before costs, beating the market is a zero-sum game. After costs, it is a loser's game. Pure Bogle.
On costs, he was fiery about costs.
Oh, yeah. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Powerful imagery. And the succinct mantra, in investing, you get what you don't pay for. Costs matter. Plus, where returns are concerned, time is your friend, but where costs are concerned, time is your enemy. Costs just eat away at you over time.
How about long-term investing and staying the course?
His most fundamental advice. Stay the course. No matter what happens, stick to your program. It is the most important single piece of investment wisdom I can give to you. And the psychological insight. Time is your friend, impulse is your enemy. Then there's the brilliant contrarian take. While the interests of the business are served by the aphorism, don't just stand there, do something, The interests of investors are served by don't do something, just stand there.
Love that one. And his realism about risk.
If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. Managing expectations is key to staying the course.
On simplicity.
Simplicity is the master key to financial success. Couldn't be clearer. And the reassuring. Investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. Keep it simple. Avoid big errors.
And on fiduciary duty and ethics, his moral compass.
That call to action. We are more than a mere industry. We must hold ourselves to higher standards, standards of trust and fiduciary duty, and the profound. It is character, not numbers, that make the world go round. Just beautiful.
Finally, any quotes reflecting his broader life and philosophy?
Yes, some great ones, like the pragmatic. The greatest enemy of a good plan is the dream of a perfect plan. Stick to the good plan, and his personal credo. One of my life principles is that the only way you can live life is by dealing with what is and not with what might have been. Acceptance and a nod to learning. An investment in knowledge always pays the best interest.
Wow. Hearing those quotes really drives home the coherence and, frankly, the wisdom of his approach. John Bogle's journey from that depression childhood through getting fired to founding Vanguard, it really was defined by rigor, resilience, and this incredible commitment to the individual investor. What a deep dive this has been.
Absolutely. Creating the index fund, that unique mutual structure, these weren't just business moves. They were the tangible results of a philosophy built on research, hard experience, and that unwavering ethical compass. The 5 pillars: indexing, low cost, long-term view, simplicity, fiduciary duty, they really do form this powerful, coherent doctrine.
And a doctrine, as we've seen, that goes way beyond just investing. It offers this practical guide for life, championing prudence, patience, clarity, integrity. In his book, Enough, just seals that connection, pushing us to think about character, contribution, and what sufficiency really means.
His impact was genuinely revolutionary. Trillions saved for investors, millions empowered. That nickname, St. Jack, whether used sincerely or sarcastically, captures the almost religious fervor he inspired, the deep ethical dimension people saw in his work. He might not have been a philosopher in the academic sense, but he absolutely lived and promoted a philosophy based on wisdom, evidence, and powerful ethical conviction.
So his legacy isn't just cheaper funds. It's a call for a more rational, more ethical, truly investor-first financial system.
And maybe most importantly, a reminder for all of us to figure out what is truly enough in our own lives, financially and personally.
So as you reflect on Bogle's life and his philosophy, here's something to consider. In this world of nonstop information, pressure to always get more, the allure of the next big thing, how might adopting Bogle's principle of enough actually change how you approach things? Not just your money, but your whole life. What are your true measures of money, business, and life?